Welcome back. Well, this has been a tough year for stock and bond market investors, but commercial property has enjoyed a revival of investor interest. Well, one company keeping busy in the sector is LXi REIT, which in February doubled the size of a sale of new shares to £250 million, reflecting strong demand. It's since announced the takeover of rival Secure Income REIT, which will make it one of the UK's 10 biggest quoted commercial property firms. Today, it announced a 33% rise in full-year operating profits to £49.2 million. Well, LXi REIT's partner and fund manager, Simon Lee, joins me now. Simon, welcome to you. For those who don't know you, what are the type of assets in which you invest?
So we invest just in UK assets that are commercial properties, but across a very wide range of sectors. So we've got industrial, we've got food stores, healthcare, and then we've got some more bespoke esoteric assets like education, life sciences. But the common theme really across all of them is that they are let on very long-term leases. So the average lease length is 21 years to first break, and virtually all of them have their rent going up in line with inflation. So that puts us into a very comfortable position in this type of climate when interest rates are rising, but so is inflation.
But I think you cap out rental increases at 4%, is that right?
That's right. Our average capped rate is 4%, but we also have a tranche that is completely uncapped. And when you add in the low cost of debt that we have, even with an average cap of 4%, then per share, that means effectively investors are getting 6% per annum growth.
Now, you mentioned there you're in quite a wide range of different sectors. Has rental demand been pretty evenly spread from sector to sector, or are you seeing disparities?
Yeah, it really kind of moves over time. And I think that's behind the strategy that we have, really, that we don't want to be allied into one particular subsector, whether that's industrial or food stores. We like to go across different subsectors so that we can move with the demand of our particular tenants. So I think we do focus principally on sectors that are non-discretionary. So, our biggest sectors are food stores, industrial, and healthcare. And across those subsectors in particular, demand remains super strong. We've now got over 70 tenants, and there is pretty much no day that goes past without one of our existing tenants looking to expand. And because we can provide capital for them that's not just passive, by which I mean we can help construct new buildings for them, we can do sale and leasebacks, we're always helping them to expand. And so that puts us really on the front foot of being able to get tenants who are in a good, strong position and are keen to pay sensible levels of rent.
Now, as I mentioned in the introduction, you're in the process of buying Secure Income REITs. What's the rationale behind that deal?
Well, I think if you strip back what appear to be complexities around a sort of public M&A transaction with things like exchange ratios, we see this really as just a really good property deal. So an incredibly rare opportunity to buy £2.3 billion worth of long income assets, where the average lease length is 30 years to first break and 99% of their income is inflation linked. And because we're doing it through a REIT to REIT merger, we're not paying the standard property costs that you would pay if you were just buying property assets. So instead of paying 7% costs on entry, we're only paying about 1%. So what that means is we're getting this huge portfolio at an effective net initial yield of over 5%, which is really accretive. I think on top of that, there's obviously good stuff around the increased scale, which gives more liquidity, and in a rising interest rate environment allows us access to the cheapest debt, the cheapest equity that's there. And I think the sort of final but not least point is that they've got a great team of property professionals, and to be able to work with them going forward is a great way to expand what we do, both from a contacts perspective and also from an investment perspective.
Now, your portfolio has already grown pretty rapidly. You've acquired 65 properties during the last 12 months. I presume as you bed in Secure Income, there isn't going to be so much room for going out and buying other things this year.
Well, I think, we're gluttons for punishment. And as you can tell from the bags under my eyes, we like to keep busy. So, no, absolutely. With the next couple of months, we'll be digesting the Secure Income REIT merger, but we are already looking at new assets, new opportunities. And as I said, with having 70 tenants within our rent roll, we're always approached by them actually proactively to help fund their new assets. And what we don't want to do is sort of say, no, we're not going to help you. We're focusing on ourselves. So I think, over the next 6 to 12 months, you can expect to see from us what we always do, which is buying into new assets, funding our existing tenants, and also recycling our capital through disposing of existing assets, because we always want to keep the portfolio future-proofed.
All right, Simon, good to talk to you this morning. Thanks very much indeed for joining me. Hope to see you again in future.
My pleasure. Thank you.